Okay, let's get started. Good morning, good afternoon, good evening. I know lots of you are joining me from various places around the world in different time zones, so I appreciate that. My name is Brian Kahn. We're going to be talking about lower volatility and what does it mean for traders and longer-term traders, maybe even investors, because I'm sure that there's a range of people that are engaged in the markets on tonight. Questions are always good. It gets me to touch on various other topics such as trading psychology, which we will touch base on probably no matter what, but fundamentals, technicals, things that I might not have specifically in these slides, but that's why I want you asking questions, obviously going into various pairs and things like that. So you have my email there. As you know, I always offer that you're able to reach out to me. You have dailyforextradingedge.com, which is IBFX's daily commentary page, where myself and other collaborators post their opinions, fundamental and technical analysis, as well as other themes I have posted there the past few days. So make sure you're reading those articles. And then my website, which does have some of the same commentary, and then also a little bit about what I do with the education and consultant side, helping individual traders. So next slide, let's just go through a couple of the compliance slides and get those out of the way. I'll just leave this up so that you can go ahead and read this. And the next slide as well. Oops. Let's make sure we have both of them. So this is the standard disclaimer from IBFX. Again, obviously understanding that the possibility exists that you could sustain a substantial loss of funds, and therefore you should not invest money that you cannot afford to lose. And then obviously the volatile markets disclaimer, which volatile, we're talking about that tonight. So obviously understanding that everything you do out there are market orders, and things can change drastically, and that's what I want you to understand as we go through the first main slide tonight, which will talk about fundamental analysis. Before that, you always know that I like to give you an outline of where we're going. And again, starting out with fundamental analysis, then technical analysis, just kind of, again, a quick overview of what fundamentally I think is driving the markets and what technically to be aware of, or what technical themes to be aware of. And then we'll get into the main subject, volatility, how to measure it using indices, and then how to measure it technically using the charts, and then how to trade it and making a trade setup. So we will go through that. And then again, always at the end, we will do a quick review. I'll make sure I answer your question, and then we will give you some links for resources. So fundamental analysis, I have there the first line, the importance of. I can't stress enough the importance of fundamental analysis, the macro events, which are central banks and international monetary funds and governments making decisions. And I actually talked about that at length today in my commentary, so make sure you do go to dailyforextradingedge.com and read today's commentary. It talks a little bit about the US dollar against the Japanese yen and a chart pattern, but it also talks at length about the fundamentals out there driving the markets. And I really keyed in on the Bank of England and what they said today as far as accommodative policy through 2015. So you just need to be aware of this because it really is affecting the markets, and really it's affecting volatility, and so that's where we'll make the link tonight to volatility from the fundamental events out there. How do you stay on top of fundamental events? Your broker, and your broker has, again, collaborators providing their opinion of what fundamental factors to be aware of on a regular basis. And then also they have a link to forexfactory.com, which is an economic calendar with events. So I want to show you that because I think it's worth going to. But before I get to that, obviously, you have Bloomberg television, you have CNBC television, so having a television nearby for breaking news is important. And obviously, it's other people's opinions, which, just like my opinion tonight, you have to filter it for your own needs. Obviously, all of these analysts on CNBC and Bloomberg TV or Bloomberg.com will obviously have their own opinions, and you'll have to filter that yourself as well. And then obviously, other market sites, you're aware that there's a plethora of market sites out there, and I'm sure that you're using them. Again, just make sure that you're filtering the data for your needs. So let's just switch the screen really quickly, and let's jump over onto the internet. And I do want to touch on this because this is a pretty good story. So here's Forex Factor. I hope that you're using it. I hope that you're aware of it, because there are events going on 24 hours a day around the world. Foreign currencies are open 24 hours a day. So even if you're trading right now in The Asian region, you're trading a pair against something else, so there may not be anything going on right now in that region, but if you leave a trade on and you're trading, let's say, against something in the European region and they're getting ready to open 4, 5, 6 hours from now, and you leave something on and you forget that, hey, you're trading the yen against some pair over there, the pound, the euro, whatever it may be, and then they have an announcement, that's what you need to be aware of. So this morning, we had, so if I go down to Wednesday here in the U.S., Thursday in other parts of the world, but we had Bank of England Governor King speaking, and then the Bank of England inflation report. And if I click on this little tab here, the first story right here, so this is a wealth of information. Obviously, this is a speaker, but when you get an economic indicator such as manufacturing data or retail sales or consumer confidence or employment data or inflation data, there's a lot of history that you can find out and a lot of good work in this little tab here. But if I click on this link here, right here, the message, and again, this is someone's opinion, the message from the Bank of England was crystal clear. Having declined to take action to bring inflation back to its 2% target for the past 4 years, Threadneedle Street has no intention of changing course now. Policy will remain unchanged or even become a little looser meaning more accommodative, which is bearish for their dollar against other currencies. Their currency would be bearish against other currencies, even though the bank estimates it will be 2015 before the annual increase in the cost of living is back on track. So they have looser economy. This is the same thing that we heard from the Euro region last week, and also in the U.S. Basically, the U.S. wasn't so much changed. It's been a pretty constant statement, but definitely the European region did the same thing. And if we go back, I can show you that data. So really quickly, I'm just going to flip now from this economic calendar, and that's why it's so important to be on top. Look at all of these events coming out tomorrow, Thursday. We have Bank of Japan, so there you go, another central bank talking right there. And then you get into the micro, I call them micro numbers. The macro numbers are interest rate policy stuff, government policy stuff, and then the micro is GDP within Germany or non-farm payrolls within France or whatever it may be. So the macro is affecting interest rates as a whole, and the micro is data on that economy specifically. So as you scroll down, again, lots of data, pretty busy data week, the Thursday, Friday for the U.S. for sure, which a lot of people are keeping on. But now if we flip into the technicals really quickly, and I'm jumping the gun, but I just want to show you that announcement about King came out right here. And look what happened with the pound. Very, very volatile. 56.80 down to 55.30, and that's a 15-minute chart. So that's basically 45 minutes or two 15-minute bars, 30 minutes. We went from 56.80 at the top down to 55.40 at the bottom. So 120 pips. So very, very volatile. That's what I mean by obviously any order that you put in becomes a market order, and it can be drastically different or away from where you intend to get in, even if you put in conditional orders. So just be aware of that. All right, jumping back into the slides, and let me just see, because again, like I said, I encourage questions throughout, so let me just see if there's anything just yet. Looks like nothing's come through just yet, but please be aware that I encourage your participation through those questions. So the importance of those current events, staying on track of them, that's something that I try and do in my commentary on Daily Forex Trading Edge, is basically make it easy for traders out there, even longer-term traders, investors, people that might not be in front of the markets, 4, 5, 6, 7 hours a day, make sure that they're getting that data. It's very, very important. And I wanted to write about the Bank of England announcement by King today because obviously we're talking about volatility, and it was just a good precursor to today's webinar. So that's how you stay on top of fundamental analysis. Technical analysis, I always, always, always say these 3 words: trends, support, and resistance. Which way is the money flowing? And then where are buyers coming in and setting a floor, and where are sellers coming in and setting a ceiling? And then you know that I'm pretty big on intermarket relationships. I think you know that I work with portfolios, and I'm in the equity markets, and I'm in the futures markets, and I'm in the options markets, and I'm looking at Forex, and I'm looking at all the markets, not just for short-term trading, but what relationships are there. And if I feel that I have a risk that I'm holding in a portfolio or in a certain commodity or in a certain Forex pair, I can always try and reduce that risk. There are no free lunches, so I'm trying to reduce that risk with a trading plan. But again, it is just a plan, and it's just that I could have a loser in my major holding, and I could have a loser in the protection that I'm trying to reduce risk with. So there are no guarantees out there, but I'm looking at more than just an entity and saying, is it overbought or oversold? I'm looking at it and comparing it to other markets and other relationships out there. So just be aware that I'm much, much more than just focused on the Forex markets, that I do trade them short term, and I also do trade them longer term for various different reasons out there. Some of those intermarket relationships that we're used to, the US dollar going one way versus equity markets going one way, that's broken down as of late, and that's fine. As long as I understand that, I'm not going to go and try and use that relationship. So just because a relationship is broken down doesn't mean, woe is me. It means, okay, I can find something else, or I just need to be aware that I don't bang my head against the wall trying to do it, and I need to adapt quickly. So as traders, we adapt. We adapt to slow market conditions, to fast market conditions. We adapt when certain things are working, and then things stop, and then we stop using them. So we need to make sure that we are very, very flexible in our trading plans. So my question for you is, what are you finding that gives you a trading edge? So I apologize, that should say gives. What are you finding that gives you an edge? And obviously, some people may be willing to share that tonight, but that's why this is great. I like talking with you guys, because this is good. The markets are big enough for all of us, and I don't think there's any problem with sharing ideas. So volatility measured. First, we're going to go and leave the Forex realm and go over to the equity realm and the indice realm and the option realm, really. And I think that that's healthy for you as traders. Again, I'm focusing on how all the markets are related. And just because you're in Forex doesn't mean that you shouldn't understand what other markets are doing. Obviously, a lot of you trade the Australian dollar or the Canadian dollar. You know that those are somewhat called commodity currencies, and sometimes there's a relationship between the commodity that is big in that environment. So the Australian dollar has a lot of gold coming out of that economy in that region, and then obviously you have the Canadian dollar, which has lots of natural resources in the form of oil and gas coming out. So we always want to be aware of other markets, and so that's hopefully something that I'll open up for you tonight. So we're going to leave the slides here, and we're going to go look at volatility as it's measured on an index. All right, and then we'll come back and then we'll start to look at trading ranges. But keep in mind, when I'm talking tonight, again, all of you are your separate little trading entity out there. When do you trade? So what time of the day? Where are you around the world? What style of trading? Are you a short-term trader? Are you an intermediate trader? Are you a longer-term position trader? What pairs, depending on, again, where you live and what time it is and what markets are moving and open where you are. So I want you to keep in mind as we move into this and take a broader look here, realistically, that's the key word, realistically look at the trading range for the period that you're trading and make sure that you're developing defined risk-reward parameters for your trading plan based on that realistic trading range, all right? Everybody's trading range will be a little bit different depending on where they are, what pairs they're trading, and how long they're actually in the markets for that trade, whether it's 5 minutes or whether it's 5 days. You have to make sure that you're developing a plan that fits your goals for that specific trade, okay? All right, so running along pretty smoothly here, let's jump into the IBFX partner site TradeStation, and we will jump into, I brought up, I was just typing this in right before I got on with you. I typed in 3 different volatility indicators. So the VIX-V you have the VXX, and then you have the VIX. You know, the VIX is pretty widely known as the main one that people use, but if you're an option trader, you can trade options on the VIX, but you can't own that entity. You can trade options and own VXX, all right? And there you have a little bit different nuances to them, but the bottom line is I want you to look at the trend of these. Can you see a similar pattern between these? They're basically measuring the same thing. They look very, very similar. Obviously, right here, a big breakdown. So right at the beginning of the year, the end of 2012, the beginning of 2013, the equity market shot up. That was the fiscal cliff in the U.S. getting solved. You had a gap to the upside, and you had a gap to the downside in the VIX-V. You had a big move down in the VXX, and you had a big move down in the gap in VIX. If I just flip this, just so you can see what the SPY is doing, it should be the opposite. All right, here's your gap right at the beginning of the year as the fiscal cliff got solved. We've done nothing but trend higher and higher and higher. Large percentages. It doesn't look like it here, but huge move to the upside in the past 6 weeks, 1,400 in the S&P up to 1525. So if you do that 125 move, you're looking at 8.9% in 6 weeks that the broad index has done in the United States. All right, so things are very well. If you're paying attention to global equity markets, you know that they're on, a lot of them are on the multi-year highs. All right, so the bottom line is, if I bring this up and blow this up, volatility has been steadily declining. Here we are in a daily chart, so we're basically looking at a year. We had a little bit of volatility in just the early part of the summer here in the U.S. We had a little part of volatility here right before the fiscal cliff got fixed, but we're making new lows and new lows and new lows. So lower highs and lower lows, and that creates what really technically would be defining a downtrend. So the question is, what are we going to do down here? Some of you may be looking and saying, hey, the equity markets are too high because of A, B, and C. Maybe I can line up a double bottom here and I can create a trading plan knowing that the trend in the equity markets have been up and the trend here has been down. So in effect, aside from the double bottom pattern, you really are going against the trend if you're thinking that the volatility is going to go up and turn around and start to reverse that. So that very well could happen. But again, a lot of you are familiar with trading patterns and price patterns, and obviously you can start to develop a plan around that. Obviously, is it premature to say this is a double bottom? Some people like to get in early, have a small amount of risk, and if they're right, they risk 1 to 2 to make 3 to 4 to 5, and that's a good risk reward. Other people like to wait for the mature move. They might be waiting for a moving average to cross, a lagging indicator, a MACD, a lagging indicator, a stochastic lagging indicator, whatever it may be. So everyone out there is paying attention to different things, but the bottom line is, please know how to use your technical analysis, all right? So just jumping back into the slides really, really quickly, I want you to realize that volatility has been decreasing as world equity markets have been increasing. And generally, what that means is there's less fear, less anxiety, and less conviction, all right? All of these governments could step in at any one time. Do you want to take a huge position knowing that the interest rates could be affected at any time by central banks jumping in? And so we're just in this time of the economy, in time of the markets, that's a fact. It wasn't always like that, but now after the Great Contraction, as they call it in 2007, 8, and early 2009, things are different. And so just keep in mind that maybe some of the larger players aren't as don't have as large amount of conviction, and we're the little guys trying to feed off of those moves, and generally the moves have been smaller. I've written a lot about volatility as of late in my daily market commentary, and it actually has just increased a little bit. The gauge itself has increased, but there's been some larger trading ranges in Forex, and I'll show you that over the past week or so. But overall, as volatility declines, conviction on the part of traders declines, and the amount of decision-making declines, so that you should reflect in your own trading frequency and trading size. What does that mean for your trading plan? Again, everybody is a little bit different, but overall, you should see a decline in volume, and you should see a decline in trading ranges, all right? Doesn't mean there's not opportunity out there, just means we have to adapt, our strategies, adapt our outlook, all right, to that. So again, I'm just checking back to see if there's any questions as I switch back and forth through programs. So please add those in as they pop up. So indices, this is a great way to look at volatility. And again, every broker out there calls it something else, but might have a different ticker in the way that they type it in, whether it's an indice, whether it's an ETF, whatever it may be. So VIX is pretty widely known. VXX, not so much, but I just put it up there just for fun, just so you could see a couple stacked up together. So trading ranges, I've talked about this. When do you trade? What style of trading? Day through position? What pairs? And realistically look at that trading range so you're not trying to make a mountain out of a molehill and bang your head against the wall by saying, I needed 50 pips, but the range that day was only 30 pips for the trading period that I was in front of that computer. Don't try and make something that isn't there. All right, be realistic. So how to trade it? Reviewing the psychological approach, that's the slide that I just put in as far as breaking down who you are and what kind of trading entity you are. So that's the psychological approach. So again, no matter if I'm writing a commentary, no matter if I'm talking live, no matter if I'm doing a webinar for people all around the world, psychology always comes into it, because I do feel, and this is something that I put on my website, that if you approach the markets unrealistically for who you are, okay, then obviously I think that sets you up for a chance at possibly failure. So make sure that you have the right psychological approach. That's something I key in on very, very closely, is making sure that I talk to that person and make sure that they're on board with what they can achieve. And a lot of people skip that step, and that can be pretty detrimental. So what are you trying to achieve? Be realistic. And now let's go in and do some trade setups. We'll go live in the markets, and this is where you could type in your pairs, your style. So this is where we could go see maybe something that you're focusing on as far as, hey, I want to look at a 5-minute chart on the euro and the US dollar, whatever it may be. All right, so just keep that in mind that that's available. Let's see if I have any questions. So I'm going to switch the screen here and go right into IBFX. All right, and I put this up here. Okay, so someone just asked a question, that's why I'm pausing. So someone just asked a question, how can we see the volume in Forex? So in the IBFX MetaTrader 4 platform, all I did was right click, and it brings me down to properties. And I go and check here over on the right side under, you can change your colors and the background and things like that, but inside the comment area, show volumes. So I don't really look necessarily at the volumes because I'm just so focused on the actual prices and the trading range. And there's some, and this is kind of good, this is why I like you guys asking questions. Volumes. People have said for years, the stock market, the equity markets cannot go higher because they're going higher on declining volume. So the point is, there's been such a fundamental pull of the markets to go higher because of the don't fight the Fed and the Federal Reserve and the central banks and Bank of England and ECB stepping in, that volume doesn't matter. The markets have been trending one way for 4 straight years in the equity markets, and anybody who was trading off of volume was wrong because they were saying the volume's going down, the equity markets are overbought, technically I'm going to sell them. Well, they were wrong because volume didn't matter, and volume still doesn't matter. So just be careful, again, whether you're using a technical indicator, a price pattern, whatever it may be. Right now, these days, technicals have definitely taken a back seat to fundamentals. So just be careful. So I did put the volume up here so you could see it here, and then you can break it down. Again, if you're looking at a 5-minute chart, if you're looking at it on daily, you can see. So again, I'm not sure what you can get out of volume, but there are people that trade off of volume very, very closely. A lot of shorter term traders do like to use that for sure, so that may be helpful. But you can easily put it on the MetaTrader 4 platform. But going back to daily, all right, so here's a daily chart so that you can see, obviously, the trading range. You can just go in and take a look and say, what's the high, the low? I'll put my crosshairs on, and you can just get an idea of what's the high and the low. And that's what I wanted you to focus on as of late, over the past week or a couple weeks or so. The bars have gotten a lot bigger here in the pound US dollar, and we've had some above average trading range days. We usually 2-3 years ago, 4 years ago, hundreds of pips a day, 150 pips, 200 pips a day was normal. We were down for a while, 70 pips, 60 pips, 80 pips, 50 pips on average, and now we're starting to see 150 pip days come in, and there are some trading strategies that I talk about in that daily forextradingedge.com daily market commentary about above average trading days and reverting to the mean and things like that. So you know, make sure that you're aware of that if you're starting to say, hey, things are picking up a little bit, what's causing it? So it's a little bit confusing because, as I said, volatility has been decreasing, equity market's still rising, but due to other things going on out there in this pair versus that pair, there have been some pairs out there that are starting to trade a little bit larger. So just keep that in mind, that we're starting to see a little bit more movement, but again, the norm has been for it to revert back to smaller and smaller ranges. So we'll see. So someone else was asking, I'm just looking at questions, so thank you. 30-minute Bollinger Bands for range. So again, so someone is saying that they may be using a technical indicator such as Bollinger Bands to see it hitting a range, and maybe they're using that Bollinger Band if it stretches too far down or up as support or resistance, and they're thinking that it might revert to the mean, or they might be saying, okay, they could use it the other way and saying it's squeezing together, I expect it to break out. They might be able to buy and go long and have an entry if it moves up and gets them in, and have an entry going that way. They can also have an entry ready to go the other way. So that's what's fun about the markets you can put in those limit orders. But again, be careful with the word limit because they do become conditional orders, which are market orders. But you can say, I want to get in as it blasts out above or below the range, and hopefully it keeps going and breaks out. So you can use it both ways, to come back in the range or to expand out to a larger part of the range. So that's what I mean by no matter what technical indicator you're using, use it in the right light. And that's what I key in on with people is a lot of people just say, oh, Bollinger Bands, they're going to hear it tonight, and they're going to go use it, but they have no idea how to use it. So there are nuances to every single different indicator out there. So I want to set up some trades for you and just looking at the pound and the US dollar. And let's just look at it. This is just a 1 hour chart. So again, we're just looking at about 3 weeks of data, and you can see these daily separators, the vertical white dotted lines there are basically separating each day, okay? So that's where you can start to get as a shorter term trader, what are the trading ranges each day and what makes sense for me. Again, none of us trade 24 hours a day. If we're a short-term trader, we might trade 4 to 5 to 6 hours of that time frame. So depending on where you are around the world, what was the range at that time? And that's what I want you to focus on. All right. So today we had a pretty fundamental event that brought us down. So now we're near these lows. I'm not just going to go and say, oh, we're low, I'm going to go and buy it. I need more data. So I go out to the hourly 4 chart, I go out to the daily chart, and then I get a little bit better understanding and say, hey, there was a lot of support down there in the past. Hey, we've just dropped significantly from the low 1.60 area down to 1.55. That's 5 pennies. That's 500 pips. Do I want to do something, whether I'm short-term or long-term? I might have the same kind of trade setup. I might just be risking a different amount of pips. If I'm a short-term trader, I might be risking 20 pips to make 30 pips. If I'm a longer-term trader, I might be risking 200 pips to make 400 pips if I think this area is going to be support and it's going to go back up. So again, it all depends on what you're doing as far as your time frame and what the charts are giving you realistically. So again, as of late, the ranges have been a lot bigger. I commented on this day. There's some trading action here on this day, huge day. There was another huge day right back here. So big ranges as of late, much larger than expected. And that's what I want you to be aware of. As the markets change, we become flexible, okay? The US yen, this is what I talked about today on my market commentary. I don't know if the equity markets are overbought. I don't know if there's been relationships that are going to come back in line where equity markets move one way and the US dollar moves one way. But this has been huge. Is it overbought? Technically, maybe it is overbought, but again, it could be fundamentally driven. But if you're going to get into it and say, I'm going to go the opposite way, could you maybe say this is a left shoulder, this might be a head, and this you're preparing for a right shoulder? But regardless of it, you have a trading plan. You have a bunch of resistance in this area, and then you might have a neckline right here, a trend line that you might want to draw. So if we draw this trend line right here, something like this, okay, at least you start to create plans. So using the fundamentals to stay on top of those, because they can change at any time, using technicals and using 1 or 2 technical tools, you can start to say, if this trend line gets broken, all right, I have the possibility of it going down to a Fibonacci number, a moving average, the next area of support. What is my goal? How many pips is that? And what am I willing to risk? Okay, I'll put my stop up above this old resistance right here, and I will, whatever that amount of pips is, whether it's 50, 75, whatever it is, and I think I can make 100, 150 out of it. That's your story. That's what you're making up. Again, if this was a 20 pip range from top to bottom, and you said, I believe I can make 200 pips, that doesn't make much sense, all right? Use the charts to tell you what's realistic. So again, the theme of tonight is less conviction out there on the part of players, because there could be a huge market moving event that could be a big move one way or the other, and it could just be on the whim of a government. So just be careful that those players are backing off a little bit and holding it close to the vest until we get out of this period, and it could last for a long time. But there still is plenty of movement out there. You just might not get the same amount of trades off per day, per week, per month that you did 4 or 5 years ago before the government stepped in to say, hey, we're here to prop up the equity markets. And generally when the equity markets go higher, the volatility, the pace of activity does decrease. All right, so that's what I'm trying to stress to you tonight. So live in the markets, again, focusing on your pairs, your style. Be realistic. I can't stress that enough. Reviewing. fundamental events, they're going to be in the front, the front of your vision all the time. Technical analysis, make sure you're making a plan using the charts. They drive every decision we make. Volatility, I showed you how to measure it, all right, and I showed you the psychological approach given your individual trading personality, and then some trade setups and a realistic approach, again, using the technical approach to the charts. So with that, I'll leave you with hopefully a couple questions will come in, but also the resources page. So we're going to meet again in 2 weeks. We're going to do a fundamental analysis catch-up 2 weeks from now. We'll do a technical analysis catch-up. Our main topic will be on technical analysis. It'll be the 5 and the 9 moving average crossover, a very short-term moving average crossover. Why? Because trading ranges have been smaller. The 5 and the 9 react very quickly, and so I want to get into something quickly, and I want to be out of something very quickly. So I want to make sure that I have the indicator match my fast trading criteria. Education recordings, again, you can reach out to me. Go to IBFX, to their education site, for all of the great analysis that's provided. And again, someone asked about volume. If you have a question about the properties of IBFX and their trading software, call them, email them, chat, get on with them, and make sure that they're helping you become a successful trader. That's what your broker is there to do, and that's what IBFX does a very good job of. Daily Forex Trading Edge is where I put my commentary. I've already put a couple articles there this week. Lots of videos. There's about 3 dozen of my videos on their YouTube page. And then at the bottom, again, my website where it describes my approach to helping people in the markets become, hopefully, reach their goals. That's what I like to do. So with that, I'll just check and see if we have any questions coming in. I think that's it. Pretty straightforward tonight, you guys, but hopefully it opened your eyes a little bit to how I approach the markets and how I think you should be approaching the markets on a regular basis. So as I always leave you, happy trading, invest intelligently, and please use my commentary, and I look forward to seeing you on another webinar in a few weeks. Thank you very much.